British Tobacco is down 20% year to date. And the reason people keep asking me about it is this wonderful dividend yield of 10%. So we're going to get into that in just a second. So guys, in this video, we're going to go through British Tobacco. We're going to go through some high-level metrics. We're going to go over some news. We're going to go over some bull and bear cases from our community members here that we asked them to put out there. We're going to go over analyst estimates, our 8-pillar process. But then we're going to finish it off with probably the most important question you have, which is, what's the right price to pay for British Tobacco? So let's go check this thing out. Guys, the market cap is $72.7 billion. That means if you wanted to buy every share outstanding, you have to spend $72.7 billion, okay? Now, very consistent. They made about $10 billion last year, and in the last 5 years, they've averaged about $10 billion. But here's something I love about British Tobacco. Last year, they did $14.5 billion in free cash flow, and they've averaged the same over the last 5 years, significantly higher than their net income. Usually, it's a much higher net income than free cash flow. So I love the fact that they have a higher free cash flow than net income. All right, look at this PE, 7.3. That's incredible. Look at their price to free cash flow, 5. Now, the one difference is, if you look right here, their enterprise value is about $157 billion, and their market cap is 73. What's the difference here? Essentially, this difference, enterprise value is if you bought the entire business and paid off all the debt and got all the cash from them, you'd have to write a check essentially for $157 billion. This difference is essentially their net debt, and that's a lot. That's $85 billion. But the good news is they generate a lot of cash flow, okay? So let's go a little bit further. 83% gross profit margin. Cigarettes are a high profit margin business. I guess that's what it is, with a bottom line profit of 25%. All right, so is this just a negative business about the fact that it's tobacco? That could be the case. That could very well be the case. Let's see. They're slightly larger than Philip Morris on net revenue, but slightly smaller on total tobacco volume. Their global brands are Dunhill, Kent, Pall Mall, Lucky Strike. Oh, Lucky Strike also owns Newport and Camel in the US. They also sell vapor e-cigarettes. Oh my gosh. So guys, a lot of potential here. Let's check out the 8 pillars in the company. Oh wow, look at this. 7 check marks. The one decline is cash flow. So this is interesting. Their net income is up $240 million, but their cash flow is down about $1 billion in the last 5 years. So let's go check out their cash flow statement. Yeah, so their cash flow here, you see the drop here over the last 5 years. It was a big drop, then started to rebuild back up. So, guys, look at this. Look at this thing. So remember, cash flow, free cash flow, is cash from operations less your capital expenditures, okay? Capital expenditures are what they invest in the fixed assets of the business, things like factories, things like that. Look at how low their capital expenditures are as a percentage of their revenue and their cash from operations. Low capital intensive business. So they don't have to keep reinvesting a lot of money in the business to maintain it. And that's an awesome fact. All right, so let's go check out some bull and bear cases on British Tobacco. So I'm going to go into our chat, go to British Tobacco here. All right, TC, Nassim, bear case, Permafrost Bear. It's a tobacco company. I don't blame you. It's legal for now. Doesn't leave me comfortable that their customers' health is worsened significantly by their product. Now remember, we're in the US. I think it was like 50 years ago, 50% of the US smoked. Now it's down to like 20%. I don't know the exact numbers, but it's down significantly. And that is a big, big factor, right? But internationally, as economies expand and start to grow, cigarette use starts to increase. So there is a lot of still potential internationally. Wicked Willie, our in-house analyst, Dalton, smoking industry is expected to grow to 9.5% CAGR, compounded annual growth rate, through 2027, while the tobacco industry is an oligopoly, with BTI holding the second most market share worldwide. New category products have grown at 33%. So they have new categories in their business, and they've been growing at 33%. The sentiment on smoking has gotten worse as the World Health Organization announced that 8.3 million people die every year due to smoking tobacco, and that 100 million premature deaths have been a result of smoking in the 20th century. In September of this year, BTI exited business in Russia and Belarus after 18 months of deliberations. Okay. Okay, so D-Money writes, very strong ROIC. That means return on invested capital. They get a really high return on the money invested in their business. Let's see what that number is right now. 23% 5-year return on invested capital. 23%. Okay, so let's go back to this thing. One of the leaders in the industry, along with Philip Morris. Debt is manageable, consisting primarily of lease obligations. Okay, having a lower share price may benefit them by buy. So he's talking about buybacks, and I agree with them. They're selling for 7 times earnings. In my opinion, this dividend yield. Let's go look at this dividend yield real quick. They pay a 10% dividend, which eats up $7.3 billion of their free cash flow. They can afford it because their free cash flow is right here. In my opinion, people are going to hate this. All you dividend lovers out there are going to hate this. Cancel this dividend. Buy back these shares. Why are you giving me a taxable event? Give me a non-taxable event. Buy back your cheap shares. Buy back all the shares you can. 15 billion. In 5 years, you could buy back all your shares. You're going to drive up your earnings per share by buying back cheap shares. That's the key, though. You've got to buy back inexpensive shares. You can't be the Nvidias of the world buying back shares that are selling for 200 times earnings. You got to buy back the cheap shares. This is the best way to give investors a higher. So look at it this way. Right now, they make $15 billion in free cash flow. Let's see how many shares outstanding they have. 2.26 billion. So let's call it $7 per share in earnings. Okay? $7 per share. If they stopped their dividend and just bought back 2 years of 15 billion at the current price, so that's $30 billion over 32 million shares. Let's call it 1 billion shares outstanding. They go from 2.2 billion to 1.2 billion shares outstanding. Now they're making 15 billion and 1.2 billion shares. That's about, what is that, $12 per share? They went from, they sat there and now at $12 per share times, let's say 12 times, the stock price is now 144. That's how you put a lot of value to investors, not paying the stupid dividend. Now, for those of you that understand what I was doing, I went quickly. When a company buys back its shares, you still keep the same number of shares you had, but now your ownership in the business has increased. So for example, if they have 10 shares outstanding, you own 1. You own 10% of the business. If they suddenly buy back 2 shares, you still own your 1 share, but now there's only 8 shares of which they have to split the cash flow and profit. Now you own 12.5% of the business, 1 out of every 8 shares. And with a company like this, with so much free cash flow and a low market cap and a low PE, buy back those shares. Heck, spend 4 years of doing it. You're going to go back, you're going to buy back. If this stock stays this cheap at 7 PE, as you buy back more shares, the PE goes lower and lower if the price stays the same. Eventually, they'll buy back enough shares where the company's making $100 per share in free cash flow if you buy back enough shares. What's that worth to you? Would you pay $30 for a company that buys back, that has $100 per share in free cash flow? Of course you would. That's the key to buying back shares. That's what interests me about BTI. But why are they doing this? They're doing this because they want people to be excited about the company. I think they should cancel this dividend and start buying back shares. Oh, man, they need to do that. They absolutely need to do that. All right, let's go back to bull and bear cases. Let's see. I'm not bullish on revenue growth. I don't disagree with you. Business has to find more users. Okay, so this is his assumptions for, oh, wow, interesting. So when we go into the stock analyzer tool, a lot of our users in the community will share their screenshot. That way we can get an input from them. And I love that because it allows a good interaction to discuss what assumptions are made. I think ethical concerns are warranted. This is not a stock for everyone, as this is a sin category. He is correct. There's alcohol, tobacco, firearms, etc. By the way, great movie to watch. Thank You for Smoking. Wonderful movie. Came out like 18 years ago, maybe 17 years ago. I saw it in the theaters. It's a great movie. Definitely depends on the individual investor to decide if they're okay with what the business does. I don't disagree. All right, guys, good engagement on BTI. Very, very, very popular company. So let's go back to the software and see what analysts are saying about BTI. Look at this. Big growth in earnings per share. 467 this year, going to 710. Guys, let's say they get to 710 in 2027. They're currently at $32. Divided by 7 equals what? 4.7 times earnings in 5 years, 4 years. This is a tough one because everybody hates the tobacco industry. I don't blame you. It's a very, very questionable what's the future of the tobacco industry. I think, though, that this low price justifies a lot more due diligence to decide if it's right for you. I do think they should be buying back shares. I absolutely think they should be buying back shares. In the last 5 years, the company has done nothing in terms of share price. But again, they've been paying this dividend. Let's see what the revenue growth assumptions are. So the revenue growth assumptions, according to analysts, are pretty steady. Not much growth. Actually, the biggest jump is in a few years. So not much sexiness here. Now, guys, it leads us to the next question. What's the price to pay for the company? That's why we have the stock analyzer tool. Now, guys, you've heard me talk about our software in our community a ton, and you're probably wondering, okay, what's it all about? So here it is. Now, I'm not asking you to make a decision yes or no right now. What I'm asking you to do is to make an informed decision. And the only way to do that is from the inside. On the outside, it won't work. You have to be on the inside using the community and the software in order to be making an informed decision. And just like if you were to go buy a car, you have to test drive the car for 15 minutes. Get a feel for it. How does it feel? How are you doing things? Same thing here. Get a feel for the software. The only difference is I am so confident you're going to love this software that I'm offering a 7-day full access, free trial, no credit card required, just your email. That's it. I'm so confident at the end of 7 days, you're going to look at the software and say, this has helped change the way in which I view money for decades to come. They'll sign up. And if you choose not to sign up, no offense taken. Move on your way. Keep watching our videos. You'll learn a ton. And maybe down the road, it'll be the right time for you. But in the meantime, in order to make that informed decision, I need you on the inside using the software. So go to everythingmoney.com, sign up today. Only your email address is needed. You get 7 days full free access on the software. So check it out, everythingmoney.com. So let's go look at BTI in terms of assumptions. Now, not much growth rate here in terms of the revenue. Profit margin is actually down a lot. Look at this profit margin. The profit margin is down, but look at the free cash flow. It's actually increased. That's kind of interesting. PE, 7.3, price of free cash flow is 5. So guys, I'm going to do some revenue growth numbers. It's a declining business. So let's assume it declines forever. For the next 10 years, I'm going to do -2, 0, and 2% revenue growth. All right? So not much revenue. Actually, you know what? I'm going to go a little bit more extreme. I'm going to go -3, -1, and 1% revenue growth. So even in my middle assumption, I'm going to assume negative growth rate. Now look, I just changed that on the spot. I use this tool as a way of guiding me, like not necessarily to say, oh, this is an exact right deal. It's to say, hey, are we in the ballpark? Now, profit margin. So for profit margin, I'm going to go 20, 24, and 28. Now, the reason I'm going to go to 28, though, is because look at their free cash flow. Over long periods of time, free cash flow and profit margin should be the same. And like I said before, I love the fact their free cash flow is higher. Now for free cash flow, I'm going to do 30, 33, and 36%. So I'm going a little bit lower, and I'm hoping there's a blend between profit margin and free cash flow. Now, PE. It's currently at 7.3. Now, what I want you to put in here for PE and price of free cash flow is, where do you think it'll be selling for in 10 years? It's not for where it's sold for today. What do you think the multiple of earnings and free cash flow will be 10 years from now? That, of course, none of these things we know, but we can make assumptions. Now, usually what I do is I start at 15, which is market average. I go higher for high ROIC, a big moat, and good growth rate. I think they have two of those. They have the high ROIC and moat. I don't think they have the growth rate, as we can see from my assumptions, right? It's pretty obvious. So the question is, what multiple would you put on here? Guys, I'm going to be conservative. I'm going to go 10, 12 and a half, and 15, because it's still a negative business that could have a lot of regulations in the future. I do think there is growth rate in the future internationally, but this one's a hard one for me because I wonder how they pivot into another avenue for them to be able to make more and more money. Now, finally, the desired return. Now, guys, this is where you have to sit there and make decisions based on what your return requirements are. As you know, you can invest, you can get 9 or 10% over long periods of time with an S&P low cost index. So what return do you want to buy a company like BTI? Every company is going to be different. Apple versus BTI versus Alibaba. So for here, since there's a lot of negativity around the industry, I really want to be conservative. So I'm going to go low side, 12.5, middle 15, high side 17.5%. And I hit the analyze button. Now, guys, there's about 1 or 2 more minutes left in this video. You need to hold on to me for just a little bit longer because I want to explain everything here, what these numbers mean, and how you can change it when you sign up for the free trial when you do BTI here. But it's really important to hang on with me. So I scroll down. Wow, look at this. A low price, 25 to 37, high price of 40 to 50, middle price of 32 to 44. Guys, but this is based on pretty high returns here. If you pay today's price and my low assumptions occur, you're gonna make about 15.5% return. If my high assumptions occur, about 21%. My middle assumptions and my highest assumptions occur, 27%. So in my opinion, guys, whether you buy or not, it's up to you. But I think it's worth taking a look at deeper. And I think there's some good engagement in our community that you can do on BTI. So again, everythingmoney.com, go sign up for your 7-day free trial. Take care.